This is Funded. When you subscribe, you turn knowledge into money. Election years run on optimism, cheaper credit, rising house prices, a sense that the tide is turning just in time. Politicians love that storyline, voters love it even more. But the market is writing a different ending, one that arrives the moment the ballots are counted. Swap rates are climbing, the yield curve is flattening, and markets are fully pricing interest rate hikes beginning in late 2026, the exact moment a new government begins to claim victory. We're joined by Westpac Chief Economist Kelly Eckhold.
Yeah, well, I mean, they got caught short a little bit by the Reserve Bank's commentary a couple of weeks ago. Everybody expected the rate cut, so there was no debate there. But what they didn't expect is that the Reserve Bank would call time on the easing cycle altogether. They had a view that there was a chance that rates might have to fall again, perhaps sometime early next year. And that was just wrong because the Reserve Bank's commentary from the governor was very clear. He basically said that it would be a high hurdle for further rate cuts. So if you think about it from the perspective of investors, if you're sitting there and you had a whole lot of investments for 3 or 5 years and you thought that there was a chance that interest rates could fall further, now you're kind of looking at quite a different distribution where 2.25 is as good as it gets. And the possibility that rates start rising a bit sooner and get a bit higher sooner, and that is what's pushing up those 2, 3, and 5 year type interest rates.
Yeah, how do rising rates in 2026 collide with the falling debt servicing costs today for the government and for households?
Well, for the government, it's not amazing news because the longer term interest rates are going up, and actually it's the longer term interest rates that the government mainly funds at, to be honest. I mean, that'd be quite common, for example, to raise money for 10 years as opposed to 2 years. So, I mean, that's not great from their perspective. For households, I don't know if it's necessarily that big a problem. What's happened is that you would have been, with Harry hindsight, better off taking your mortgage for 5 years or for 3 years 3 weeks ago. But even if you take it out today, you're still getting a rate that's pretty close to 5% and probably a bit lower. So it's a pretty decent interest rate. So something that I think probably will help a lot of household budgets if they're sort of looking at getting into the housing market.
The 20-year average for rates is closer to 7%, isn't it?
For the bond rate, I'll take your word for it. I don't have that number in my head, but what we have tended to see with long-term interest rates is that for 20 or 30 years, up until about, I'd say 3 years ago, interest rates had just gradually, steadily fallen. You know, like back in the 1990s, 10-year bond rate up over 10%, got down to almost zero, basically, during COVID. Globally, what we've seen now is interest rates heading back up again. So we don't really expect to see interest rates at the levels you saw perhaps through 2015 to 2020, and definitely not at the levels that we saw during COVID. So, you know, we're back into a world where, you know, a 4 or 5% interest rate perhaps isn't particularly unreasonable.
Well, the coalition government campaigned on a bit of an austerity plan, and it doesn't seem to have come about. How much of the current recovery conditions that we're in are being artificially boosted by the government continuing to spend money rather than dial things back?
Yeah, on that debate, I mean, both sides of this debate have a point, right? Like, there hasn't really been real austerity because, you know, government spending is not really any lower than it was expected to be back in 2023. Government debt is not falling, for example, and is predicted to sort of like remain at around current levels for the next few years or so. So in that sense, there's been no significant austerity. You know, public sector employee numbers, for example, are only, I think, 1% lower than they were at the end of 2023. But what has happened is that the rate of growth in government spending has been curtailed quite significantly. And that is what I think people have been feeling in parts of the economy that are particularly reliant on government activity. So that's that Wellington region, parts of the construction, non-residential construction industry, for example. It's that kind of like change where, there were a lot of drugs being like thrown into the economy through 2018, 2023, and now the drugs have been withdrawn.
What role does the global monetary policy play in these projected 2026 hikes? Is everything just following the American model, or is it something different?
Oh, I think it's a bit different. I mean, the US, they cut rates this week, and they still expect to make further interest rate cuts over time. They think there might be one in 2026 and maybe a bit more in 2027. Not really talking about putting rates up right now. In the United States and in Europe, Canada, and even places like Korea, you've actually seen interest rates rise in those jurisdictions as well. So, for example, Australian interest rates at the 2-year part of the curve risen about 50 basis points in the last few weeks or so. And that's just that flicking over of people thinking that the RBA might hike as opposed to it's going to being cutting. So, to some extent, what we're seeing in New Zealand is also being reflected in other economies. And I would suggest to you that it's not necessarily that they're being driven by each other. It's been driven by the fact that all of these countries have lots of rate cuts in the last year or 18 months. And those rate cuts are starting to have an impact now. And as a result, central banks are going, well, probably done enough for the time being. And then the natural question then becomes, well, when do you normalize interest rates? When do you take them back up from what are currently stimulatory levels to neutral levels?
Business confidence, consumer confidence looks to be going to, keep growing through 2026. Are we going to see then there's going to be mortgage pressure again towards the end of the year, and that's going to get in the way of contributing to what you guys are projecting is GDP forecasted growth getting in that 2-3-4% range?
Well, certainly in a relative sense, that's right. And I would say that the Reserve Bank's commentary here hasn't really been helpful. I don't think they really expected or wanted mortgage rates to be rising at this stage. I think they would have been happy with them staying around about where they were. I think in an ideal world, the Reserve Bank could come out and correct the record here and just remind people that they weren't really talking about putting rates up in the middle of next year. I don't think that would be an unreasonable thing for them to say. But that being what it is, you're still, though, looking at interest rates that aren't particularly high, even after some of the recent adjustments. So I don't think we're at like choking off the recovery type levels just yet.
Well, you definitely are seeing the independence of the Reserve Bank from government. Is that independence strong enough to raise rates towards the end of the next year and beyond during a fragile recovery? Certainly, if the government was in charge of it, they would be doing things differently.
I think it depends on the strength of the recovery, to be honest with you. My forecast is they start raising rates in December, and that will have meant that interest rates will remain at these low levels for a year, and that's pretty normal period of time. A lot can happen in a year if you've got stimulatory interest rates, and I think you could be surprised at just how kind of much better the economy feels in 6 or 9 months relative to how it has felt in the last 6 or 9. The thing, though, is that we really never know exactly what's going to happen. I think it is quite difficult, for the Reserve Bank to start a tightening cycle during an election campaign. And the election is likely to be in that kind of like October, November timeframe. So that tells me that they'll either do something after the election, after the economy's had a decent head of steam for a while, that'd be December, or maybe if things go quite well in the next 6 months, perhaps they can get that going closer to September before the election campaign. And one of the things there I would think about is that it may not necessarily be laying out a path of hundreds of basis points of rate hikes, but they might be thinking about, well, these last 75 basis points of cuts that we did, taking the OCR to 3%, which is where they think neutral is, down to 2.25%, maybe they could just take those back and just say, well, we thought we needed a bit more stimulus in 2025, perhaps by middle of 2026, they're looking at it and go, well, that's not appropriate anymore, so we just take those back. We're not talking about taking rates back up to 5%, but you might just be like just resetting yourself to the middle of the road. And I could imagine that being something that could occur if the economy and if the labour market starts to perform strongly for a period of time.
And how destabilizing it is it to have the opposition throwing out election promises around, say, for example, pay equity, around capital gains, all sorts of election promises that will cost tens of billions. Is that going to put pause to the economy with a big wait and see approach?
Yeah, my concern about this is, there's merits to different policies, but what it all does smack is quite a lot of uncertainty, because there's quite different policy ideas now being thrown at voters and will increasingly be thrown at voters in this election. And they'll have quite big distributional implications. So there are going to be winners and losers, right? So if you're sitting out there as a business, you're trying to run a business and you think, oh my goodness, what's the operating environment going to look like for me? If housing policy changes quite a lot, or if tax policy changes quite a lot, if environmental regulations change by quite a lot, these are the sorts of things that could leave some businesses to think, well, I'm just going to stop here and wait and see till the election, and then I'll know whether it's worthwhile investing or not. My sense is that if the economy has a good head of steam up by the time we get to the middle of the year, businesses will shake this off and they'll just get on with doing what they do. If that hasn't been the case, if things are still looking a bit ropey, then actually maybe businesses will stop once we get into the second half of next year, and we could end up with a disappointing year.
Well, you went straight back, Kelly. Appreciate your insights today. You've got a long-term mindset, and you've seen things around the world that you bring those insights to us. So I appreciate that. Now we'll catch up again soon.
Thank you.
Most people treat their KiwiSaver the way they treat an old photo album. They know it exists, they know it matters, they never bother to open it. And that small act of neglect can cost them more than they realize. If you want clear, simple guidance on choosing the right provider and the right type of fund, you can talk to Wealth HQ without paying a cent. Maybe you like the thrill of crypto. Maybe you want nothing to do with investments that profit from conflict. Maybe you just want a sense of control over where your money goes. Wealth HQ strips the uncertainty out of the process. If you want to understand your options, the link below will take you there.